Have you ever wondered what the no-brainer portfolio by Bill Bernstein is all about? Welcome to the world of simple yet effective investment strategy. The no-brainer portfolio, a brainchild of William Bernstein, was introduced in his book, The Intelligent Asset Allocator. The beauty of this portfolio lies in its simplicity and diversification. It's as uncomplicated as it gets, with an equal allocation of assets across 4 core asset classes. So what does this mean? It means that your investment is spread evenly, reducing the risk associated with putting all your eggs in one basket. Let's break down these asset classes to get a better understanding. The no-brainer portfolio has a 25% allocation each to VEA, VB, BND, and VOO. These cover international developed markets, U.S. small-cap stocks, the U.S. total bond market, and U.S. large-cap stocks. Now let's talk numbers. As of January 13, 2024, the portfolio has returned negative 0.83% year-to-date. However, over the past decade it boasts a 6.91% annualized return. With a Sharpe ratio of 1.05, this portfolio offers acceptable risk-adjusted returns. But what about dividends and expenses? Well, the portfolio has a dividend yield of 2.33% and an impressively low expense ratio of 0.04%. Even the best investment strategies are not immune to market downturns. The maximum drawdown for the portfolio was 27.91% on March 23, 2020. However, it bounced back in 99 trading sessions. The current volatility is 2.97% over the past month. Intrigued? Well, you should be. Let's delve deeper into this fascinating investment strategy. The first asset class in the no-brainer portfolio is international developed markets, represented by VEA. Now, what exactly is VEA? Known formally as the Vanguard FTSE Developed Markets ETF, VEA is an exchange-traded fund that tracks the performance of a benchmark index that measures the investment return of stocks issued by companies located in Canada, Europe, and the Pacific region. This means that when you invest in VEA, you're gaining exposure to a wide variety of companies from these developed markets all in one go. But why include international developed markets in your portfolio? Well, there are several reasons. Firstly, diversification. By investing in international markets, you're spreading out your risk across different economies. If the US market takes a downturn, your international investments can help cushion the blow. Secondly, potential for growth. Developed markets outside the US include some of the world's largest and most successful companies. From German automobile manufacturers to Japanese electronics conglomerates, these companies can offer significant potential for returns. Lastly, currency diversification. Investing in international stocks gives you exposure to foreign currencies. If the dollar weakens, your foreign investments could potentially increase in value when converted back into dollars. But, like all investments, international developed markets come with their share of risks. Economic and political stability can vary across countries, affecting the performance of your investments. Currency risk is another factor to consider. While a weak dollar can boost your returns, a strong dollar can do the opposite. It's also important to note that VEA has a dividend yield of 2.33% and an expense ratio of 0.04%, which is considered low. This means that the cost of owning this fund is relatively inexpensive, allowing more of your money to stay invested and grow over time. Despite these risks, the potential benefits of diversifying your portfolio with international developed markets make VEA a key component of the no-brainer portfolio. As part of a balanced investment strategy, it can help provide a mix of capital appreciation and income while offering diversification benefits. So that's the first piece of the puzzle. Now let's move on to the next one. The second asset class in the no-brainer portfolio is U.S. small-cap stocks, represented by VB. Now you might be wondering, what is VB? VB is an exchange-traded fund or ETF that aims to track the performance of the CRSP U.S. Small-Cap Index. This index is essentially a benchmark for U.S. small capitalization stocks, and VB includes over 1,300 of these smaller, potentially faster-growing companies from all across the United States. But why should small-cap stocks be part of your portfolio? Is it just because they're in the no-brainer portfolio? Well, not exactly. Small-cap stocks play a vital role in a well-diversified portfolio for a few reasons. Firstly, they offer the potential for higher returns. Small companies often have a lot of room to grow, which can translate into significant capital appreciation for investors. This isn't always the case, of course, but the potential is there. Secondly, small-cap stocks can provide diversification benefits. They often perform differently than large-cap stocks, and this lack of correlation can help to smooth out the returns in your portfolio, reducing the impact of any single asset class performing poorly. However, it's important to remember that with potentially higher returns come higher risks. Small-cap stocks are often more volatile than their large-cap counterparts. They can experience larger price swings both up and down, and they might even be more susceptible to market events. Another point to consider is that small companies often have less access to capital, which can make them more vulnerable in a downturn. Additionally, they might not have the same level of operational efficiency as larger companies, which can impact their profitability. Despite these risks, the potential benefits of small-cap stocks make them an important part of a diversified portfolio. And remember, the no-brainer portfolio doesn't just include small-cap stocks. It also incorporates international developed markets, U.S. total bond market, and U.S. large-cap stocks, which can help to balance out the volatility of the small-cap sector. That's the second asset class in the no-brainer portfolio. Let's now explore the third one. The third asset class in the no-brainer portfolio is the U.S. total bond market, represented by BND. Delving into the world of bonds, BND stands for Vanguard Total Bond Market ETF. This fund offers a broad exposure to U.S. investment-grade bonds. Reflecting this goal, the fund invests about 60% in corporate bonds and 40% in U.S. government bonds of all maturities, short, intermediate, and long-term issues. Why are bonds crucial to any portfolio, you might wonder? Well, they serve several key purposes. Firstly, bonds provide a source of regular income. Most bonds pay interest, known as the coupon, on a fixed schedule, which can be a valuable source of steady cash flow. This can be particularly beneficial for those who are retired or nearing retirement and need a consistent income stream. Secondly, bonds can help to protect your portfolio against the volatility of the stock market. While the returns on bonds may not be as high as those on stocks, they tend to be more stable. This stability can help to balance out the potential ups and downs of your stock investments. Moreover, bonds are a way of preserving capital. When a bond matures, the bond issuer returns the principal to the bondholder. This means that unless the issuer goes bankrupt, bondholders can expect to get their initial investment back, something that stock investors can't always count on. However, investing in bonds is not without risks. The main risk is that the issuer will default on their payments. This is why it's important to consider the credit quality of the bonds in a fund. BND, for instance, invests primarily in investment-grade bonds, which have a lower risk of default. Another risk with bonds is interest rate risk. When interest rates rise, bond prices fall. This can lead to losses if you need to sell your bonds before they mature. However, if you hold on to your bonds until maturity, you will receive the agreed-upon interest payments and your principal back, regardless of interest rate fluctuations. Finally, inflation risk is another concern. If inflation rises, the purchasing power of the fixed interest payments from bonds can be eroded. However, this risk can be mitigated by investing in inflation-protected bonds or by having other assets in your portfolio that are likely to do well during times of inflation. In conclusion, while bonds may not offer the high potential returns of stocks, they can provide a steady income, help to protect against market volatility, and preserve capital. That's why they are a crucial part of the no-brainer portfolio. Now that we've covered the third asset class, it's time to discuss the final one. The final asset class in the no-brainer portfolio is U.S. large-cap stocks, represented by VOO. Now let's dive into the heart of the American economy. It's large-cap stocks. These are companies with a market capitalization of over $10 billion. They are typically industry leaders and household names. Think Apple, Microsoft, Amazon. VOO, or the Vanguard S&P 500 ETF, is a fund that tracks these big players. It's like owning a slice of the top 500 companies in the US. Sounds pretty neat, doesn't it? VOO is an essential part of the no-brainer portfolio, making up a quarter of the investment strategy. So, why are large-cap stocks so significant? Well, they offer a mix of stability and growth potential that is hard to beat. These companies have weathered economic storms and emerged stronger. They are often global leaders in their industries, and their revenues are well diversified across various markets. This, in turn, provides a level of resilience and predictability to your portfolio. But it's not just about stability. Large-cap stocks can also offer compelling growth prospects. Many of these companies are at the forefront of innovation, disrupting industries and shaping our future. Investing in VOO is a way of betting on the continued success and ingenuity of American businesses. Of course, no investment comes without risks. Despite their size and stability, large-cap stocks are not immune to market volatility. Economic downturns, changes in consumer behavior, or shifts in technology can impact these companies. However, the diversified nature of VOO helps to mitigate these risks by spreading your investment across different sectors. Another key advantage of VOO is its low expense ratio. Investing shouldn't cost an arm and a leg, and with VOO, it doesn't have to. With an expense ratio of just 0.04%, VOO is a cost-effective way to gain exposure to US large-cap stocks. In the end, the inclusion of VOO in the no-brainer portfolio is about balance. It offers a mix of stability and growth potential, providing a solid foundation for your investment strategy. It's about owning a piece of the American economic powerhouse and betting on the continued success of its largest companies. With that, we've covered all 4 asset classes in the no-brainer portfolio. Let's summarize what we've learned. So, we've taken a deep dive into the no-brainer portfolio, but what does it all mean? In essence, the no-brainer portfolio, as presented by William Bernstein, is a straightforward yet diversified investment strategy. It allocates assets equally across 4 core classes. International developed markets, US small-cap stocks, the US total bond market, and US large-cap stocks each hold a 25% stake. This balanced approach aims to provide a mix of capital appreciation, income, and diversification benefits. The portfolio has shown an annualized return of 6.91% over the last 10 years, with a Sharpe ratio of 1.05, indicating acceptable risk-adjusted returns. The expense ratio is a low 0.04%. And the dividend yield is 2.33%. However, it's crucial to remember that investing also carries risks. The maximum drawdown for the portfolio was 27.91% in March of 2020, which took 99 trading sessions to recover. The current volatility is 2.97% over the past month. Now that you know the ins and outs of the no-brainer portfolio, you're equipped to make an informed decision about your investment strategy. Remember, investing is not a one-size-fits-all approach, and it's important to consider your own financial goals and risk tolerance.